$17.5 billion. That is the number the U.S. Department of Energy just put on the table for nuclear. Not a study, not an executive order. A conditional loan commitment for long-lead equipment on 10 reactors.
Yeah, and, at the exact same time, you had all these other massive pieces moving.
Right. I mean, in that same week, Canada published its first ever national nuclear strategy.
And Walmart signed its first nuclear power deal.
Exactly. Oh, and the world's largest uranium producer told the market again that it will not flood the supply.
It really is just this profound collision of capital and policy, all converging in a matter of days.
It is. So welcome to the deep dive, everyone. We are unpacking the week of June 23rd through the 27th, 2026.
And for you listening at home, our sources today are a pretty thick stack of market reports, press releases, and strategic policy documents.
Yeah, all detailing what is basically the Uranium Unleashed renaissance. Our mission today is to synthesize how all of this collided in a single week.
Because the dominant thesis across all these sources is really clear. Western governments have they've stopped debating whether to rebuild nuclear capacity.
They're just doing it.
Right. They are actively competing on who gets there fastest, all while the supply side, the actual physical fuel, remains structurally constrained.
Okay, let's unpack this, because before we get into the billions of dollars, we really need to look at the scoreboard, right?
The spot market.
Yeah, the current price of uranium, because it might be tricking casual observers. So, uranium U3O8 spot closed the week totally flat at roughly $85.85 per pound.
Firmly in that $83 to $87 range.
Exactly, the same range it's held since mid-April. And the long-term contract price is just sitting there at about $80 per pound.
Right.
So, if the spot market is the thermometer for uranium, why isn't it boiling after a week of massive structural news? I mean, is the thermometer broken?
Well, what's fascinating here is that the spot market is just the wrong instrument to read right now.
Wait, really? Why?
Because the physical spot market is incredibly thin. We're talking about maybe a few dozen transactions weekly.
Oh, wow, that's nothing.
Right, it's mostly residual activity. True institutional conviction, the real money, lies in the term contract pricing.
Because utilities don't buy fuel for the next decade on a week-to-week spot market.
Exactly. So the flat spot price is actually a setup. It's a lagging indicator. The gap between what policy is signaling and what buyers have actually contracted is narrowing.
Okay, so that $5 spread between the spot price and the long-term price.
Yeah, that just reflects producers' willingness to lock in long-term contracts rather than sell into a super thin spot market. They're holding their ground.
Okay, so since the spot price isn't the real signal, let's move to the central piece of architecture that is the real signal.
The U.S. Department of Energy.
Yes, this massive move. So on Monday, June 23rd, the DOE's Office of Energy Dominance Financing issued a conditional loan commitment.
$17.5 billion.
Right, and this is for long-lead components. We're talking pressure vessels, steam turbines.
The stuff that takes years to forge.
Exactly. And this is for up to 10 Westinghouse AP1000 reactors across 5 paired projects.
And 7 utilities have already signed letters of intent.
Yeah, but I want to clarify something for the listener. This isn't the government just handing out a blank check. It's more like a matching grant where you really have to prove you have skin in the game.
That is the crucial detail. It's not just the dollar amount, it's the co-investment requirement.
Meaning they have to pay to play.
Exactly. Each utility and Westinghouse must commit $500 million in equity up front.
$500 million just to get access to the loan.
Right, and that filters out all the speculative infrastructure pipe dreams. It ensures you have committed counterparties,
It's not just a PR stunt.
Exactly. And the timeline compression here is massive.
Yeah.
By financing these long lead parts now, they're accelerating deployment by up to 3 years.
So what are the dates on that?
Starting construction by 2030 and operations by 2035.
Wow, okay, let's do the math on the fuel for that. 10 AP1000s at 1.1 gigawatts each. That is 11 gigawatts of pure baseload power.
Which requires a staggering amount of fuel.
Right, because each one needs about 500,000 pounds of U3O8 initially, just to start up.
And then another 150 to 200,000 pounds annually.
For decades.
Yeah, the demand curve is just locked in.
And I really want to point out how this impacts Cameco, because this was interesting. Cameco owns 49% of Westinghouse, right?
With Brookfield owning the other 51%, yeah.
Right. So because of that, Cameco isn't just a uranium miner anymore.
No, not at all.
They are a reactor technology company with a direct revenue line into this exact policy. every AP1000 order flows through them.
Exactly, which completely changes how you have to value them long term.
Okay, so Washington is laying down capital. But here's where it gets really interesting.
Let me guess, we're heading north.
Yes, to Ottawa. Because they were drawing up their own sovereign battle plans for nuclear dominance at the exact same time.
June 22nd.
Right. Canada announced its first ever national nuclear energy strategy.
Which is incredibly ambitious.
Yeah, they want up to 10 new large reactors, 2 under construction by 2035 and 5 planned by 2040.
And we should remind everyone, Canada already produces 24% of global uranium.
And they exported 90% of it in 2024.
Right, so their strategy has these two dual goals. They want to double their uranium exports.
Which would add roughly 20 million pounds a year to global supply.
Yeah, but at the same time, they want to maintain sovereign control of CANDU reactor technology through Atkins-Realis.
And that's a big deal, because Atkins-Realis just filed a notice of intent with the U.S. NRC to license CANDU reactors in the U.S.
If we connect this to the bigger picture, Canada is treating uranium as a strategic geopolitical export.
It's not just a commodity to them anymore.
No, it's leverage. The CANDU reactors are unique because they run on natural, unenriched uranium.
Using heavy water.
Right. So you bypass the entire enrichment bottleneck. This means the regulatory and financial infrastructure to accelerate mine development in Canada is going to have massive political tailwinds.
Because it's literally a matter of national strategy now.
Exactly.
Okay, so governments are creating the supply and technology frameworks. But on the commercial side, the demand is evolving far past the usual suspects.
You're talking about the Walmart deal?
Yes, the June 23rd Constellation Energy and Walmart deal. Walmart signed its first ever nuclear power purchase agreement.
A PPA for 176 megawatts.
Right, of emissions-free electricity from the Dresden Clean Energy Center in Illinois.
Yeah.
But here's the crazy part to me. It's for a high-tech, perishable distribution center.
Not an AI data center.
Exactly. We always hear about tech companies and AI. But why is a big box retailer buying 15-year staggered nuclear contracts starting in 2029?
Because Walmart is a fiercely CFO-driven, risk-averse organization.
They don't do things just for the PR.
No, they move on value, not headlines. If their cold storage loses power, millions of dollars of food spoil.
So they need baseload reliability.
Exactly. And this normalizes nuclear power for the broader commercial sector. It proves it's not just a Silicon Valley tech obsession.
Right. And Constellation is fulfilling this through 30 megawatts of incremental efficiency uprates at the Dresden plant.
Which is a crucial detail.
Yeah. I mean, proving that existing reactor capacity can generate new uranium fuel demand without even needing new plant approvals.
Right. To run the plant hotter, they need more fuel. It tightens the supply chain immediately.
Okay, so we have government momentum. We have unprecedented commercial demand. So what does this all mean for the supply side?
Well, the world's largest uranium producer is responding by keeping the taps tight.
Yeah, Kazatomprom. On June 23rd, MNing.com published an interview with their CEO, Mirzan Yusupov.
And they produce 40% of the world's primary uranium.
Right. So you'd think they would just flood the market to capture all this new demand, right?
Standard economics would say yes.
But Yusupov emphasized this value over volume discipline, and he's heavily focused on the East.
Because the shift in customer mix is undeniable, Asia is moving incredibly fast, and honestly, they're less price sensitive.
Because it's about energy security for them.
Exactly. China is targeting over 100 reactors by 2030 and 200 by 2040.
And India is aiming for 100 gigawatts by 2047 under that Shanti Act.
Right. So Kazatomprom doesn't need to dump cheap uranium into the West. In fact, there's a massive logistical shift happening.
A Trans-Caspian Middle Corridor.
Yeah. That route now handles 50 to 65% of their Western deliveries, specifically to bypass Russia.
Which is wild, logistically. But the most crucial downstream detail from that interview, to me at least, is that Kazatomprom is exploring its own conversion capabilities.
Oh, absolutely. That could fundamentally reshape Western supply chain security.
Because right now, the West relies on Western facilities to convert that raw yellowcake into a gas for enrichment.
If Kazakhstan starts doing the conversion themselves, they control the choke point. They move up the value chain.
Wow. So just synthesizing all of this, the convergence this week is staggering.
It really is.
Government capital, sovereign strategy, commercial retail demand, all accelerating simultaneously.
While the largest supplier holds firm on restricting volume.
Yeah. And it's funny, even with all of this, junior and mid-tier miners like UEC, remain sort of range-bound.
Despite companies like Energy Fuels running at historic low processing costs, what, $9 to $12 a pound at the White Mesa Mill?
Exactly. It just shows the broader market is still trying to catch up to the reality of the policy.
Well, there are two immediate catalysts listeners should watch for.
Yeah.
First, specific utility equity commitments. When those utilities actually put down that $500 million to activate the DOE loan, that's huge.
It makes it real.
Right. And second, Cameco's Q2 earnings on July 31st, 2026.
Because that will show how much the market is pricing in that Westinghouse optionality.
Exactly.
All right, well, we've covered a lot of ground today, but before we go, we like to leave the listener with something to mull over.
And this raises an important question, actually.
Yeah, something that was buried in the news this week. We saw Holtec and EDF submit a UK SMR proposal.
Small modular reactor.
Right alongside all these large-scale AP1000 CANDU advancements we just talked about.
So if small modular reactors and large-scale gigawatt reactors are advancing on these separate, simultaneous technology tracks,
what happens to global supply when all these different reactor classes hit the exact same uranium feedstock bottleneck at the exact same time in the early 2030s?
it is going to be a fascinating squeeze to watch.
It really is. Well, something for you to think about. Until next time, thanks for joining us on this deep dive.